Hello, hi everyone. A very good morning. How are all of you doing today? So, just a quick question: can all of you hear me, see me? I can see a few of you already. Hi Ajay. Hi Meenu. Hi Mohit Bansal. Hi Mr. Khan. How are all of you doing? Hi Mohit. Okay, no problem. I hope you liked the session on debt funds, and good to have you back on this particular session. So just a quick question: if all of you can, if someone can just tell me if I'm visible, if I'm audible, anyone? So just put it on the comments, guys, and just tell me yes, you're visible, yes, you're audible, so that I know that all of you can hear me, all of you can see me. Yes. Okay. Great. Thank you so much. Thank you. Hi, Shubham Chaudhary. Good morning. Hi. Thank you so much, Mohit. Thank you so much. Okay. So yeah, so we're just gonna wait for 2-3 minutes, guys, because we're just waiting for some more people to join in, and I hope that's okay with all of you. Hello, Narsimhan sir. Welcome back. Good to have you back in my episode. Hello, Rajesh Punjabi. Thank you so much. Good morning. Shubham, thank you. Okay. Okay. Hello, Mr. Narayanan. Yes. Okay. Welcome back. Welcome. Hi. Good morning, Mohammed. How are you? So, how are all of you doing today? How is your weekend going? So, just a few questions. Give me answers to whatever questions you want. Okay. First question: how many of you are new to my session? So, how many of you are attending my masterclass for the first time? Second, I want you guys to tell me, is there any specific expectation you have from this particular masterclass? Hello, Golden Bird Music Channel. Hello, Mr. Manish, Suresh, Vaibhav. Hi, Manish Yadav. Hi. Okay, so Manish, you're attending my session for the first time. All right. Nobajyoti. Hello. Okay. Okay, Rajesh Punjabi for the first time. All right. Okay. How about the rest of you? So, how about a few of you who've logged in? Yes. So, can I get some more replies? And any specific expectation from this class, guys? Please do let me know. Hello, Sridev. Hi. Okay, so Mohammed is saying it's his first class as well. Okay, great. Good. Cool. So just another 1 or 2 minutes, guys. I hope that's okay. We're just waiting for some more people to join in. Okay, Shivam is attending my class for the first time. Okay, welcome, welcome all of you, all the first timers. Welcome to my class, and of course, all of you who've been attending my master classes for the past. Thank you so much for, for coming back, for liking these sessions, for posting your comments. It truly, as a trainer, it is very motivating when I see a lot of good, attendance, and at the same time good comments. And of course, feel free to give me any feedback, guys. More than happy to take feedback and improvise on myself. So, yes. Hi, Prashant. Good morning. Hello, Abhijit. First time. Welcome. Okay. Gautam. First time. Okay. Hi, Suman. Hope you're doing well. Okay. Regular attendee. Thank you, Mr. Narayan. Thank you so much. Okay. Anoop. Hello. Welcome. Okay. Oh, thank you so much, Sridhar. Truly, truly. It's glad. I'm glad to know that you look forward to these classes every Sunday. I look forward to doing these classes every Sunday. I know it's a weekend, but then, I'm very excited to be doing these classes on Sunday mornings and meeting all of you. So it's nice. Thank you so much. Hi, Manoj, and Nabujyoti says the first class. All right, okay. And then I have Webhav. I have a doubt. Okay. Okay, so Vaibhav, I'll try to answer your question when we discuss. Okay, Sham is attending for the first time. Thank you so much, Manish. Thank you. Hariom. Okay. So I think let's start now. And of course, people are joining in, and we already have a reasonable chunk of people. So I think we can start. So I think all of you already know my name. I'm Namrata, and I've been working with Groww for a really, really long time now. And we've been creating a lot of content with Groww. We've been doing a lot of, these kind of episodes with Groww so that a lot of people get some good knowledge before they make their investments. We've also started a new series on the Groww Mutual Fund channel, which is called The Basics of Mutual Funds, where we're coming out with different episodes, and I'm handling those episodes. So do feel free to go back to the Groww Mutual Fund channel and go through those episodes that we are creating for you. So this particular masterclass that we do, so it's a masterclass that we do every Sunday morning for all our viewers, and all the subscribers who and we try to cover a particular topic every Sunday where we try to talk in detail about that particular topic, right? So today's topic is asset allocation and hybrid funds. Now, why did we think that we should exclusively cover hybrid funds as well? Because Hybrid funds is a very interesting category, and a lot of people don't know much about it. And I do feel that hybrid funds as a category is something that everyone should understand. At the same time, we've recently covered debt funds and equity funds in detail. So my last masterclass was on debt funds, and before that, we have covered equity funds also in detail. So we thought hybrid funds would be a good addition to bring the two categories together. So my class is structured in such a way that first I'm going to talk about hybrid funds, and then I'm going to talk about asset allocation. Hybrid fund is a way of asset allocation any which ways, right? So we're going to talk about these things today. If you guys have any questions, any doubts, feel free to mention it in the comments, and I'll be more than happy to take these questions towards the end of the session. Okay. So let's get started. And before we do that, let me share my screen, because a lot of times I tend to forget that. I just assume that the screen is visible. So let me just share my screen right away with all of you. Okay, I have made a very interesting presentation, so I hope you guys can see it. Yes. Okay. Cool. So let's start. Come to look at it, like I said, we have done in detail about all these topics, correct? So we have spoken about equity funds, we've spoken about debt funds, but we have spoken to them spoken about them in isolation. So equity as a category, debt as a category, right? Now, come to look at it. If you look at anything in life, I truly believe balance is a very important thing, right? And I'm sure all of you would agree with me that anything which has good balance is what that is going to be successful. So, for example, we all have a left brain and a right brain, and I'm sure all of you are aware of that, right? Now, the left brain is basically the logical brain, yeah, and the right brain is basically the creative brain. But tell me something: if we had only the left brain or only the right brain, do you think we would have become balanced individuals? If someone was only logical, only analysis, and there was no softer side to that person, do you think that person would have been successful? Or just the creative side? So we have people who are just creative, who have no who don't really are who are not really very logical, or who don't really analyze too much. Do you think that would work? The thing is, even nature in itself has created a lot of balance. We as individuals need the left and the right, of course. And some people, left might be a little more dominating compared to the right, and right might be a little more dominating compared to the left. But you need a balance of both the sides, right? Also, now I'll give you another example. So, for example, all of us love drinking our coffee, right? And we all know that coffee is made from coffee beans. But how many of you know that it's not just the coffee beans that makes you that perfect coffee? So, coffee beans are mixed with something called as chicory, which makes it like a perfect coffee, and that too in a particular proportion. So, the two have to be mixed well in a particular proportion. Only then you get your perfect coffee at home. Okay. So, what I'm trying to tell you is it's the right mix which is super important. And it is not just about one side of the story, you have to understand the other side of the story as well. So, if we take this learning to our investment practices, all of us know equity is a great investment class from long term wealth generation. Yes, we've discussed it, we've spoken about it, we've analyzed it, we've done a lot of discussion around equity, and we all understand that in the long term, equity has the potential to give us great returns. Whereas when we look at debt, for all of you who attended my debt sessions last week, you would have understood that debt provides stability to our portfolio. Yes. So, ideally speaking, don't you think it would be great if we can bring the best of both these into one particular category? Yes. So, what I'm trying to tell you is that there is a particular category. All of us, if we are looking at investments, if we can get a balance where we are saying that, okay, it's something that generates great returns for us, and at the same time, it also brings in that stability or reduces the risk, then why not? Right? And that particular category is called hybrid funds. So today, in this particular class, I'm going to spend the first part of my talk on hybrid funds, where we're going to discuss in detail about different categories. So when we're talking about hybrid funds, so hybrid funds could be basically a combination of two or three different types of investments, or even asset classes for that matter. Okay. But the most common type of hybrid funds that we see are basically those hybrid funds that combine equity with debt. So you combine equity with debt, and that's the kind of hybrid fund a lot of us would like to invest in. So under this particular category, under the hybrid funds category, we have three different types of funds. So we have conservative hybrid fund, we have aggressive hybrid funds, and we have dynamic asset allocation funds. So we also call them BAF, or balanced advantage funds. Okay. So I'm going to be talking about these three categories in detail. Of course, there are other types of hybrid funds as well. So we have balanced hybrid funds, we have multi-asset allocation hybrid funds, and so on. We'll talk about those very briefly towards the later part as well. But we're going to focus on these three categories because these are the three categories that really bring us the returns, and these are the three categories that can provide you, returns based on your investment objective. Okay, so let's start with the first one, which is conservative hybrid fund. Now, conservative hybrid fund, as the name suggests, are conservative in nature. So when we say they're conservative in nature, it basically means that they invest a big chunk of the portfolio in debt and there's a small allocation to equity. So when we're looking at debt hybrid funds, they invest close to 75 to 90% of the portfolio only in debt, which means debt instruments, and the remaining 10 to 25% goes into equity. So which means the 10 to 25% of the portfolio goes into equity stocks. Okay. So which is why when we're looking at conservative hybrid funds, the ideal investment horizon that you look at is about 2 to 4 years. So whenever you're looking at conservative hybrid funds, you invest. So when you have your financial goals in place and say a particular financial goal is getting achieved within 2 to 4 years, then these are the funds that you could consider in your portfolio. We're going to talk about asset allocation as well, so you'll understand how to structure it completely. But conservative hybrid fund, the ideal time horizon is 2 to 4 years. Now, come to look at it, given enough time, these conservative hybrid funds have the potential to beat debt and to beat debt funds, the returns in debt funds, and other fixed income products. So other fixed income products like FD, NSE, and so on. So conservative hybrid funds, if given the right amount of time, can beat those returns as well. And I guess that is what we want when we are looking at a relatively low risk portfolio. Correct? So if you look at this, right, I'm showing you the returns in conservative hybrid funds. Yeah. Now I'm sure looking at these funds in the table, you would say, wow, these are great returns. And, this is what I would, I mean, why not invest in these funds if I'm getting 12, 14, 10% kind of returns? The problem is that in the last 2 years, these funds have given pretty good returns because equity has done well. Okay, equity returns have been on the higher side. So it is always good to keep a lower expectation, is what I would say. Don't have very high expectation. Keep lower expectation. So, for example, when you're looking at a or we call them debt hybrid funds or conservative hybrid funds, you should have an expectation of whatever is the FD return plus 2 to 3%. Right, so basically if your FD is giving you say about 5% return, you can have an expectation of 7 to 8%. That is the kind of expectation that you should have from a conservative hybrid fund. Yes, so these are annualized percentages, these are CAGRs. Okay, now I'm repeating again, for conservative hybrid funds the ideal time horizon is 2 to 4 years. Okay, now the next category that we have are your aggressive hybrid funds. So when we say aggressive hybrid funds, as the name suggests, these are more aggressive in nature. These are slightly more risky, slightly more volatile, because in aggressive hybrid funds, a higher allocation goes to equity and lower allocation goes to debt. Okay, so in aggressive hybrid funds, what happens is about 65 to 80% of the portfolio comprises of equity alone, and the remaining 20 to 35% of the portfolio goes into debt. Okay, so like I said, these are more aggressive in nature. These are a little more risky, definitely more risky compared to conservative hybrid funds, but they have the potential to give us better returns compared to conservative hybrid funds. But then again, since these are more risky, since these are more volatile compared to debt hybrid funds and aggressive hybrid funds, also called equity hybrid funds, the time horizon for an aggressive hybrid fund is slightly longer. And when I say slightly longer, it's about 4 to 6 years kind of time horizon that you look at. So you look at 2 to 4 years for conservative hybrid funds, and you look at 4 to 6 years for an aggressive hybrid fund, because the allocation in equity is on the higher side. And because these are slightly more risky, we have to give them a little more time. Okay. Now, so when you see, of course, you see the performance of hybrid funds. So let me just maximize the screen for you to understand this. So because during these years, right, when equity markets have underperformed, the performance of these funds also will get impacted, obviously. So you see that, 2017, 18, if you look at the returns, these are the kind of returns that you are getting in, aggressive hybrid funds. So if you look at the chart, the category average returns of equity hybrid funds vary based on the performance of equity markets, right? But if you give it enough time with adequate time horizon, this category of fund takes care of the risk involved by generating the returns in the long term. Okay, so if you just look at some of the returns that we have, I'm sure it's visible to all of you. So as you can see, when you give it sufficient time, these funds have the potential to give us better returns, and they are lower in terms of risk as well, right? Because there's a debt component which is included. So these are your aggressive hybrid funds, which is truly a category that one should consider if your time horizon again is 4 to 6 years. Now, the next category of funds that we're looking at is your BAF or Balanced Advantage Funds. We also call them Dynamic Asset Allocation Funds. So now, what are these BAF? So come to look at it, we discussed about conservative hybrid or debt hybrid funds, and then we discussed about aggressive hybrid funds. So we also call them equity hybrid funds. What if we could combine those two as well? So when you combine those two is when we get this category, which is your Balanced Advantage Funds or your Dynamic Asset Allocation Fund. Now, as the name suggests, it is dynamic in nature. So when we say it is dynamic in nature, it basically means that the fund manager has the flexibility to change the debt and equity allocation from 0 to 100% based on how the market is doing. Okay, so the fund manager could put even 100% in equity, 0 in debt, or 100% in debt, 0 in equity, or whatever percentage in between, depending on how the fund manager believes the market is going to move forward. Okay, so it is purely a call of the fund management team based on which the dynamic asset allocation is decided in terms of how much equity and debt is going to be allocated in the portfolio of this particular fund. So let me give you an example. So firstly, what you have to understand, the logic that each fund house or each mutual fund company applies could be different, right? Because every fund management team is going to have a different logic, different style of investing. Yeah, so each fund house could have dynamic asset allocation funds where the logic is going to be very different, and then the returns are also going to be different in that sense. So let me give you an example. So an AMC might decide that based using the price to book ratio, they're going to judge the market levels. Now, as the markets start going up, which means the PB ratio also starts going up, the allocation to equity would start going down in this case. So when the markets are going up, the allocation goes down in this particular logic that the fund house is applying, which means that the fund starts selling equity, and as the markets start falling, the exposure to equity goes up. So this is one of the logic that they could apply. Now, by following this strategy, what exactly are they doing? The fund aims to limit the downside of the risk and obviously, participate in the upside of the equity market. Yeah. So in the similar fashion, we could have other logics. Other funds could apply different logics, and that could reduce their, and they could reduce or increase their allocation to equity based on the logic that they have decided. Now, a very big advantage of aggressive hybrid funds and dynamic asset allocation funds is the taxation. Okay, which I'm going to talk about right now. So in terms of your conservative hybrid funds or your debt hybrid funds, it's the debt taxation which is applicable because there's a big chunk of debt in that particular portfolio. For aggressive hybrid funds, or we call them equity hybrid funds, and for dynamic asset allocation funds, the taxation which is applicable is the equity taxation. Okay. And because of that, it becomes super lucrative from an investor's point of view because of equity taxation in these two categories of funds. So why is it that equity taxation is applied? Because the fund tends to hold average of 65% exposure to equity during the year. So as per the SEBI norms, if a fund has 65% or more of an investment done in domestic equities, then equity taxation is going to be applicable. So in these two categories of funds, they tend to hold on an average of 65% equity in a particular year. So in equity, what's the taxation? It's simple. If when we're looking at a holding period of say 1 year. So for example, if you invested in an aggressive hybrid fund or an dynamic asset allocation fund, and you are taking out your money within 1 year, so then you'll have to pay short-term capital gain. So whatever is the gain, you have to pay 15% tax on that particular gain. Okay. Whereas if you look at long-term capital gains, which means you invested in any of these two categories of funds and you're taking out your money after 1 year, then long-term capital gains is what you have to pay, and whatever is the gain basically on your portfolio, you remove 1 lakh from that, and you pay 10% on the remaining yield. So just on the profit that you've earned, you remove 1 lakh from the profit, and on the remaining profit that is there, after removing 1 lakh, you pay 10% as the tax, which is long-term capital gains. Okay? So that's the kind of taxation which is applicable. I hope, Mr. Nanda, that answers your question. Okay? So now for dynamic asset allocation funds, what you look at is the time horizon should be anywhere between 3 to 6 years. Okay, because these are a combination of debt and equity hybrid funds. You look at a time horizon of about 3 to 6 years for this category of funds. Okay. Now, basically, balanced advantage funds or dynamic asset allocation funds are ideal for those investors who are looking at, say, medium term, who want to achieve those medium term financial goals. Okay. So, medium term asset allocation is done in dynamic asset allocation funds. Asset allocation funds. So, Mr. Narayanan, if that answers your question, AAF is asset allocation funds. Okay. Now, let's look at who these funds could also be useful for. Okay, I truly believe, I don't know how many of you are looking at, are from the retired investors category, and if not, I'm sure you have your parents who would benefit from this. So, this category of funds are very useful for people who are nearing retirement or who have already retired. Okay, this is a good category to have in your portfolio. Now, why is it so? See, retired investors are looking at regular withdrawals from their investments, right? So, if suppose you're retired and you don't have any pension that's coming in on a regular basis, then you're going to redeem investments from your funds on a regular basis. And that could be done through a process called as SWP, which is systematic withdrawal plans, right? So, if you've invested in a fund like this, which is a dynamic asset allocation fund, they could wait, say, for a period of, say, 3 to 4 years, invest for, say, 3 to 4 years, and then start the SWP process, which is a systematic withdrawal plan. Okay. And they could benefit immensely out of it. And I'll tell you how. See, what's the biggest risk that a retired investor faces? And I really want all of you to listen very carefully to this. If not for yourself, for your parents, if you're helping them with their investments, this is going to be very helpful. Okay. So when you are looking at a retired investor, the biggest risk that a retired investor faces is the inflation risk. So because of inflation, the value of their portfolio is going to continuously come down, right? So now that's a big challenge. Beating inflation with your post-tax returns. So you have your investments and you have to pay taxes on it. Post-tax, whatever returns you're getting, beating inflation with that kind of corpus may not really help, and you might just actually, the retired investors might just use up their portfolio in their lifetime. They might not be able to use it till the end of their life. Okay, because even the fixed deposit returns on the downward trend, come to look at it. So in that particular case, when the retired investors have invested their entire investment corpus in debt portfolio, they are not going to be able to manage it effectively, because the debt portfolio is not going to help them in you getting used up till their end of their life. Okay, so which is why you look at a slight allocation to equity, so that it betters your return and helps you in beating inflation. Okay, and the next biggest benefit in a systematic withdrawal plan is the taxation part, which I'm going to explain. Okay, so let me explain this to you. So when we are talking about, so this we've already discussed, yeah. So when we are talking about taxation in the case of SWP, so for example, imagine a scenario where you had invested, say, about 32 lakhs about 2 years back, and the value of that portfolio is about 40 lakhs today. Okay, and you have invested that amount in, say, equity hybrid or a dynamic asset allocation fund. Now you are going to start your SWP from third year. Yeah, so you're starting your SWP from a third year, and so you are withdrawing 20,000 rupees every month, which means in a year you're withdrawing about 2.4 lakhs, right? Now, in this particular case, what is the investor going to assume? The investor is going to assume that you have to pay tax on the 2.4 lakhs, correct? But as per the tax department, what you're going to do is, if you're withdrawing from an SWP, it is not just the interest or the profit component. There's also a principal component, which is your investment amount. So you don't have to pay the whole the tax on the whole amount that you have withdrawn. You're going to pay only on the profit part. So, for example, if we assume that the profit is, say, about 20%, okay, which means in the 2.4 lakhs, the profit is about 48,000, and your capital, and your principal is 1,92,000. Effectively, you have to pay zero tax. So, SWP is very beneficial from a taxation point of view. SWP is like SIP. SIP is systematic investment plan where you're investing on a regular basis. SWP is systematic withdrawal plan where you're withdrawing money from your mutual funds on a regular basis. And because it's not just the profit component, it is also the principal component. You actually, if this is the example that you see, you would not be paying any tax at all. So taxation is a big benefit in the case of SWP. So there's no percentage in terms of how much SWP there should be. It is depending on the amount that you need, right? So your SWP is done as the amount that is going to help you in your living expenses. So whatever are your living expenses, you have to, take that out on a monthly basis, and that's about it, right? Now there are also other categories of hybrid funds. So things like, so you have multi-asset fund. Now what is a multi-asset fund? Multi-asset fund is which invests in multiple assets. So you have funds which invest in a combination of equity, debt, and gold. They become multi-asset funds. Okay. Then if you also look at other categories of funds, so we have something called as arbitrage funds, right? Now what are arbitrage funds? They invest in equity and equity derivatives markets, but invest only in risk-free opportunities. To a large extent, only risk-free opportunities. So the returns which are generated by these funds can be compared to that of liquid funds. Okay, so we have in the debt fund category, we have the liquid funds, and the benefit is the equity taxation. So it's like a liquid fund, which is, so it's the arbitrage fund that I'm talking about. It's a liquid fund kind of returns with equity taxation, and its ideal time horizon is about, say, 1 year. Okay, so I do believe that hybrid funds play a very important role in asset allocation, wealth creation, and really reducing the risk of the portfolio. So our whole portfolio risk goes down when we look at asset allocation, and ideally you have to select the right set of funds. So now what we're going to do is we're going to talk about asset allocation in detail. That if we have spoken about debt, we've spoken about equity, we've spoken about hybrid funds, then how do I structure my portfolio as an investor so that I'm able to build that portfolio for myself, which is able to fulfill all my needs. It is able to give me good returns, but also reduce the risk that is there. So let's start with asset allocation in that sense. So, what questions do we have? Where should I invest? How to get the best possible returns? There are some constant questions which are running in our mind. Now, where to invest, I do believe is a constant battle. So, if you come to look at as an investor today, we have so many investment options that are available to us. Just within the debt category, we have, say, fixed deposits, we have NSCs, PPFs, SSY, then we have, so many other government schemes. We have mutual funds and debt category. Then if you look at equity, we have, say, mutual funds, we have stocks, then you have gold as an investment, you have real estate as an investment. So come to look at it, as an investor today, we are bombarded with, a ton of investments coming our way. And then how do we invest? How do we decide which investment is going to work best for me? And the problem is, as a human mind, we are always going to wonder that, had I invested in that investment, maybe my portfolio returns would have been slightly better, right? So which is why I'm going to teach you how you can build a good portfolio for yourself. Is it the best with the best returns? Maybe not, but you have to apply the right strategies. Okay, if you apply the right strategies and identify the right funds, you will be able to manage your risk and your returns quite effectively. Okay, so let's understand that when we have so many of these investments, and a lot of times we probably would take a lot of emotional decisions. So then which investment option is really best for me, and where should I put my money so that I'm able to get the best return? Well, the answer is, how do you solve this problem? The answer is that you can't put all your money in one investment, right? It has to be a combination. So first, let's understand the different asset classes. So all of us have different asset classes which are available to us. So like I said, we have equities, we have fixed incomes, we have real estate, and we have gold. So if you look at any product which is available to us, it will fit into one of these four categories. It'll either fit into equity category, it'll fit into fixed income category, real estate, or gold. Okay, so let's start with understanding about equity. That when we are looking at equity, what is it that equity can help us do? So of course, equity has the potential to give us good returns. I mean, I don't think there's any arguments around that. All of us understand that if invested in the right products, equity has the potential to give us good returns in the long term. And of course, long term is something we've spoken about a lot in our previous session, that with long term, our risk tends to reduce and our returns tend to average out. Yes. So if we look at this particular, asset class, for example, so when we are looking at equity as an asset class, then the question is, what are some of the benefits that we look at, right? So, if you look at other asset classes, so you look at asset classes like gold, real estate, these are tangible asset classes, which means you can see them, you can feel them. When you look at equity, it's not tangible in nature. You can't see it. I mean, you are holding it digitally, right? Even if the price goes down for your gold or for your real estate, you will not sell it. But if the price goes down for equity, you will sell it, right? So let's understand that, how can we look at the benefits. So let's look at the benefits of equity. Of course, it is a very interesting asset class. All of us like it, and I guess that's the reason all of us want to learn about equity as much as we can. But of course, what are some of the benefits? So we did this guy has a potential to give us good returns. It beats inflation because we're getting good returns. We are able to beat inflation and create that wealth for ourselves, right? What are some of the other advantages? Other advantages, you can invest in small amounts. You don't have to invest like a big amount. So if you're buying a real estate property, for example, you'll have to invest a big amount at one go. In equity, you can invest as small as 1,000 rupees, 2,000 rupees, and start your equity investments. And liquidity is a great part. You can take out your money, and you can take out in smaller parts as well. You can withdraw even a small amount if you want. You don't have to withdraw as a whole thing. So if in gold and in real estate, if you're selling it, you have to sell the whole portion that you have. Correct. In real estate, you can't just sell one room in your house, right? You have to sell the whole property. So equity, the biggest benefit is that you can invest in small parts, you can withdraw in small parts, and liquidity is there. Liquidity is one of the best aspects about this particular asset class. But what are the drawbacks? The drawbacks or the risk associated is, of course, it is risky in nature, right? All of us know that equity comes with its own set of risk. It can't, if it was such an ideal asset class that it gave us liquidity, it gave us good returns, and it had zero risk, then why would we even worry about investing anywhere else? So, of course, risk is something that comes with equity, which all of us should understand. And of course, timing is important. That's what a lot of people believe, at least in certain categories of funds or stocks. Timing definitely becomes important. And yeah, of course, it is volatile. There is no denying that. So, risk is there, and we have to try to overcome that risk by designing that portfolio for us. Okay. Now, the next asset class that we have, which I'm quickly touching up on these asset classes for you to understand, is fixed income. So, fixed income could be your fixed deposits, could be your debt category of funds, and so on. Of course, it's lower in terms of risk, but it provides the stability to our portfolio, right? So, the risk aspect, which is there in equity, gets reduced in debt. And that's one of the big advantages of investing in fixed income products. But the downside is that, again, the returns are limited, right? You can't get very high returns when you're investing in debt, right? Your returns are going to be limited to a particular extent, and because the returns are limited, you will not be able to beat inflation. Now, beating inflation is one of the criteria for all of us when we are investing our money, and if we are not able to beat inflation, then I don't know if investing really makes sense in that in that scenario. So yes, which is why it is very important that we do look at the downward side as well of debt. It is not just about reducing the risk; it is also about optimizing the returns. All of us love fixed deposit for a certain reason, right? Because we get that constant, or we know that we are going to get so much, right? Which may not be the case in other investment products. Now, if you look at the other asset classes, so for example, we have gold. Now, gold as an asset class is something all of us love. There was a time when gold was the most predominant investment class or asset class in India, especially if you look at the first half of the previous century, where we had our grandparents, our great grandparents, they invested a lot of money in gold. And why did they invest so much money in gold? For a very simple reason: they were living in very uncertain times, right? I mean, think about it. The 20s, 1920s, 30s, 40s, they were so uncertain. I mean, as the world saw so many wars. There was World War I, World War II. We had in India, we had the partition. We had the struggle for independence. The kind of struggle, the kind of scenario that they were facing was very different. So then, come to look at it, what is that one asset class that you can own that can help you in rebuilding your life. That one asset class in those days used to be gold, because you can physically take it with you anywhere. So even if, say, during partition, for example, people who were migrating from Pakistan to India or from India to Pakistan, and they had all their they had their real estate properties in both the countries, and people had to leave all their houses and their properties and shift to a different country. What can they run with? They could run away with gold and then rebuild their life in the other country. And that is why gold was a very, very predominant asset class in those days. Has it reduced its charm? Maybe not. We still love gold as an investment class, but is gold the only investment that we make? No, right? Of course, gold is an important part of our portfolio for multiple reasons, and I'm going to show you that. But gold can't be the only asset class in our portfolio. And also, we don't live in times like those where we have to run away. I mean, I think we are very lucky as a generation to be living in pretty stable times, right? So, what are some of the benefits of gold? Like, of course, a global asset class, it is recognized globally, right? Which is a great thing. Also, it reduces our portfolio risk in equity, because our gold and equities generally tend to negate each other. They are inversely proportional to each other. I will show you that in the example as well. And gold again has the potential to give us good returns, right? So why not? So of course, an asset class that we should hold in our portfolio. Cons, similar to equity, of course, it has a downside. It is risky. The gold rates have been pretty volatile in the last few 2 3 years. I'm sure you guys would have realized it. When markets were volatile, gold rate goes up. When the markets are more stable, gold rate tends to be stable or comes down. So, of course, the gold rate also keeps changing, right? And I think another big challenge with physical gold is the storage part. A lot of us don't even take into consideration the fact that if you have physical gold with you and you're keeping that money in the you're keeping that gold in a locker, you also have to consider locker fees that you're paying. Locker fees is easily 6 to 7 thousand bucks every year, and we don't even consider that. But you should consider the locker fees as well while you are calculating your actual returns in gold, and locker fees will eat into your returns, right? So yeah, with gold at this point, I'm saying physical gold. I mean solid gold or jewelry. But otherwise, of course, there are digital ways of investing in gold, which we'll talk about. Okay. Next is, of course, the real estate, right? Real estate as an investment. So, of course, these are the ways that you could invest in gold before I move on to real estate. So, like I said, you have physical gold. But of course, physically keeping gold could be a pain. Like I said, because of the, of course, physically holding it, and at the same time, the locker charges. So, you could look at electronically investing, like your exchange traded funds, gold mutual funds, sovereign gold bonds, and so on. These are like digitally investing in gold, right? So now, what about real estate? So when we look at real estate as an asset class, real estate, obviously you have your personal assets and you have your investment assets. Yeah. So what are your personal assets? So your primary house in which you're living. So basically, any property that you own, which you are from which you're not getting any income, becomes your personal asset. So if you have a house of your own in which you're living, or you have a house in your hometown in which your parents are living, or say you own a farmhouse or something which you've not given on, I mean, which you're using for your weekend purpose or whatever, those are your personal assets. Your investment assets are, say, you have a commercial property you've given on rent, or you have a house that you've given on rent. All these become investment assets. So, any asset from which you're earning some form of income is an investment asset, and from which you're using any form of real estate that you're using for your personal use becomes your personal asset. Now, if you look at the RBI, savings survey, household savings survey, which was done in 2017, it indicates that as Indians, the largest holding at this point in time that we have are most of our savings actually go in real estate. Okay. And that's one house that we are living in. So the first house that we buy for ourselves, the house that we are living in, we tend to spend most of our money. And as per the demography, buying a second property really is quite unlikely. Okay. So now the question is, if we have equities, we have debt, we have gold, and we have real estate. So which investment option is the best for us? And our life seems quite simple with these four options. So we start thinking of our favorites, right? I mean, when we know that, okay, if it's only these four options, then let me think what is my favorite investment option. So if you were to invest only in your favorite investment option, it's like building a cricket team for yourself with all 11 batsmen. So imagine if you had all 11 batsmen in your team, what is your probability of winning, right? Think about that. So which is why even in a cricket team you have a balance. I'm sure all of you agree. So you need specialists You need to have your bowlers, you need to have your fielders, you need to have your batsmen, you need to have your spin bowlers, fast bowlers, and so on. So you need to have a combination of everything to build that ideal team for yourself. Just only bowlers, only batsmen are not going to get you anywhere. Correct? So, which is why it is very important that when we are looking at our investments as well, we look at building that cricket team for ourselves, which really is able to give us that that optimal return that we are looking for. So now when we are looking at that balanced team, it's not necessary that all the players in your team are going to perform well. Out of the 11 players, even if 3 to 4 players do well, right, you'll still have a chance of winning. Right? So it's not necessary that you have to have everyone doing well. Even if a few players, because a team game, you will still be able to get your returns. Okay. So now let me show you this asset allocation table. Okay, so I'm just going to maximize the screen for all of you to just look at it. Now I'm just going to show you the color. So for example, these are different asset classes. So in 2012, for example, mid cap gave the best returns. But in 2013, mid cap was somewhere down in terms of returns. In 2014, mid cap went up again. In 2015, it was around 7% return. 2016, mid cap was again down. So what I'm trying to say is you have different asset classes. So similarly, if you look at real estate, 2012, 17%, 2013, 7%, 14, 15, again on the lower side in terms of returns compared to other asset classes. So no asset class gives you high returns or is on the top of the list consistently throughout every year. So, what I want you to understand is that asset classes perform differently in different years. So, if you have a combination of all the asset classes, you can actually build a brilliant portfolio for yourself so that when a particular asset class is not doing well in a particular, you have some other asset class which is doing well to get you your returns. Okay. So, which is why it is very important to understand that not all asset classes will perform well or will be the top performer throughout consistently every year. Similarly, even the sectors change over time. It's not just the asset classes, even the sectors. So, for example, if you look at 2010, we had the consumer durables which were doing well, but in 2011, it gave negative returns. I mean, much lower than the other sectors. 2012, it did okay again. Then it was top again in 2014, 15 also, but 16 again, it was at number 7 or 8. So every sector, similarly, if you see FMCG, right, which is light green. So third, it was at ranked number 5. When 2011, it gave good returns. It was in the top. 2012 at number 2 position, but 2014 again down. So what I'm trying to say is even sectors perform differently over different economic cycles. Yes. And that is why when we are making our investments, we have to understand or we have to make sure that, while we are making our investments, we invest in a combination of everything. Okay. So, what I'm going to tell you is what are some of the strategies that you can apply. So, let's first understand the different strategies. So, we have strategic asset allocation and we have tactical asset allocation. So, what are these? Okay. The strategic asset allocation is basically something that you look at far off, something that you invest for the long term, something that you invest with a far sightedness in place. Okay. So your strategic asset allocation is going to tell you what is going to happen tomorrow. Okay. At the same time, what is tactical asset allocation? Tactical is basically tells you what is happening right now. What are some of the opportunities that I can use right now to build my portfolio? What are some of those opportunities that I can make use of right now to get my returns? Okay. So basically, think of strategic as long term, think of tactical as short term. Even in our Shastras, right? We have something called as Sarv Drishti and Garud Drishti, right? So, what is Garud? A Garud is basically an eagle. So, an eagle sightedness. So, Garud Drishti. So, why is it called strategic? Is called Garud Drishti, and tactics are called Sarv Drishti. And why is it called so? So, if you look at an eagle, right, where it is flying high in the sky, it can look really far. It can see what is happening at a really, really far off distance. And that is why you call Garud Drishti as strategic way of thinking. Whereas, if you look at a snake, right, and if you put a snake in a room, for example, it cannot see anything. A snake's vision is very, very limited. So it starts moving around, it starts taking out its tongue and starts feeling what is around it. Okay, and based on that, it decides what to do. So, what is a snake doing? A snake is basically looking at opportunities around and then managing its life, right? So, which is why when we look at strategic, we look at what is far, and tactical is what is here, what is the opportunity to be taken use of at this point in time. Okay. So, now when we are looking at strategic and tactical asset allocation, how are we going to do that, right? Generally, like I said, tactical asset allocation is considered to be a little more easy, a little more convenient. Okay, because a lot of people find it a little easy to invest in the tactical way of investing, and strategic requires a lot of time, requires a lot of effort, requires a lot of patience, which generally investors don't tend to have. Okay, so let's understand that if I want to build my strategic and my tactical portfolio, how do I go about doing it? Yeah. So, rule number one, have your financial goals in place. I'm sure all of you know it, that financial goals, having your financial goals is the first step of becoming a good investor. If you have your financial goals and if you know exactly when you're going to achieve a particular goal, to a large extent, your life is sorted. Okay, let me tell you that. So when you have your financial goals in place, you're going to have some goals which you want to achieve very close by, some goals which are pretty far off, right? So for example, you may want to buy a car in the next 1 year, maybe a house in the next 5 years, maybe retirement after say 20 years, and maybe your children's education after 10 years. These are your financial goals. So you have two goals which are relatively short term and two goals which are relatively long term. Then how do you build your financial goals to be able to manage all these financial goals, right? How do you build your investment portfolio? So first is you divide all your financial goals into short term, medium term, long term. Yeah, that is super clear. So short term is 0 to 3 years. Any goal you want to achieve in the first 3 years is short term. Between 3 to 7 years becomes medium term, and more than 7 years becomes long term. Okay. So now, when you have that clarity in terms of your financial goals, you know that okay, I have my short term goals, medium term goals, long term goals. Then how do I go about building my portfolio to achieve these short term, medium term, and long term goals? Yeah. So let's understand that. So when you're looking at short term, okay, now within short term also you could have different time horizons. So I'll break it up for you. Okay. So when you have, so what is the approach that you should take for your short-term financial goals? Of course, you could look at investing in fixed deposits, right? Because they are a debt instrument which gives you fixed returns. But along with fixed deposits, if you could combine little bit of debt funds, your returns could definitely be better. So we spoke about debt funds in detail last class, where we spoke about short-term debt funds and long-term debt funds. I would say that for your short term goals, you could invest in a combination of fixed deposits and short term debt funds to really better your returns as compared to only fixed deposit, because fixed deposit returns are quite low. Okay. So if your time horizon is say 30 to 45 days only, so say you've just invested for say 1.5 months, then you could look at liquid funds. Yeah. 3 to 6 months, you could look at ultra short duration funds. 6 to 12 months, you could look at low duration funds, and then 1 to 2 years. So if your time horizon is more than 1 year, less than 2 years, you could look at say funds like floating rate funds, banking and PSU funds, corporate bond funds, and so on. Now, when you're investing in a debt fund, you should look at those funds whose average maturity of the portfolio matches the investment horizon, matches your investment horizon. So for example, if your investment horizon is 6 months, and the debt and you invested in a particular debt fund, so the maturity of the bonds in that debt fund should also be maturing within the next 6 months, or even that the average maturity of that particular bond should also be 6 months, because that is how you're able to manage your returns effectively. Okay. So like I said, it has to be a combination of debt funds and fixed deposits for short term. Now, for short term, strictly stay away from equity, stay away from gold, stay away from real estate. In the short term, you do not take risk with any of these asset classes. It has to be purely fixed income in the short term. And in the short term, when I say fixed income, fixed deposits and debt funds are the only things that you look at. And debt funds is basically a short term debt funds. Now, for medium term goals, right? So, when you have medium term goals, you could invest in a combination of debt and equity. And I think this is where hybrid funds would fit in, which we have discussed at the beginning of the class. So, for example, if your time horizon, so any goal that you want to achieve, say within 2 to 4 years, then you would be looking at funds which are higher in terms of debt. And when you are looking at 5 to 6 years, you could look at funds which are higher in equity. So you look at conservative hybrid funds and you look at aggressive hybrid funds for your medium term goals. Okay. So, for example, like I said, if it's say your time horizon is 3 to 7 years, right? If your time horizon is say 3 to 7 years, then you could take a little bit of risk with equity and you could build that hybrid portfolio for yourself, which where you could look at aggressive hybrid funds where 65 to 80% is going into equity and the remaining is going into debt. Okay. So, like I said, your medium term goals are going to be achieved by your hybrid funds. Or again, you could look at an equity and debt combination for yourself, right? You could look at a combination of equity mutual fund and debt mutual fund individually, or you could invest in hybrid funds. Either way is fine. But you have to have a combination of those for your medium term goals, which is very important. So for lesser time, 2 to 4 years, conservative hybrid funds, 4 to 6 or 4 to 7 years, aggressive hybrid funds or dynamic asset allocation funds are ideal. Okay. Next is long term. So when I'm looking at long term, then what do I do? So when you're looking at your long term goals are going to be a combination of equity, gold, and debt. Okay. You are going to put everything in all the three asset classes you're going to put for long term, but obviously your equity allocation is going to be on the higher side. So which means in equity, you are going to invest at least 70 to 80% of your long term portfolio. So, for example, if your financial goals are retirement and children's education, and say you want to invest 20,000 for it every month, so which means your long term goals, if 20,000 is going to be your investment, then 70 to 80% of that 20,000 could go into equity, and the remaining could go into a combination of gold and debt. So maybe about 10% in gold, 10% in debt, if you're putting 80% in equity. But you have to have a combination of all the three with a higher allocation, of course, given to equity, which is important. Okay. Because in the long term, you have to beat inflation, and equity is the only asset class that can help you do that. So now the question is, if I have to put in equity, 70 to 80% in equity itself, there are so many categories, so many funds. How do I invest? So I hope till now it is clear to all of you. So we have short-term financial goals for which you exclusively put in fixed income products like FDs or debt funds. Then you have your medium-term financial goals in which you could put in a combination of debt and equity, or you could just make your life simple by investing in hybrid funds. 2 to 4 years, you look at conservative hybrid funds. 4 to 7 years, you look at aggressive hybrid funds or dynamic asset allocation funds. For the long term, for all your long term financial goals, you may put in a combination of debt, equity, and gold, where highest percentage goes to equity. So a big chunk, at least 70 to 80% goes into equity, 10 to 15% in gold, 5 to 10% in debt. Now the question is, this equity, 70 to 80%, where should I invest that? Right? So for that, I've explained the concept of core and satellite portfolio to you. Okay, so I'm going to explain what is core and satellite portfolio. Your core portfolio is your main portfolio. Your satellite portfolio is your side portfolio. So it's like, in your meal, for example, your core portfolio is your rice, is your chapati, is your dal, and your vegetable. These are the constants. These are the items that fill your stomach. These are the boring items, but they fill your stomach. Your satellite portfolio are your chutneys and your pickles and your papad, which is going to add that excitement to your taste buds. But when eaten in excess, they can cause indigestion. So your satellite portfolio is a portfolio which has to be there as a small part of your equity portfolio. So when we say core portfolio, what are your core portfolio funds? Your core portfolio funds. So when you're looking at mutual equity mutual funds, your core portfolio funds are your large cap funds, mid cap funds, flexi cap funds, multi cap funds, ETFs, which is index funds or exchange traded funds, ELSS funds. And you have large and mid cap funds as well. So basically, your core portfolio is going to be that portfolio which is going to comprise of your main funds, large caps, mid caps, flexi caps, multi caps, and so on. Your satellite portfolio, on the other hand, is going to be your funds like your small cap funds, sectoral funds, thematic funds, which are going to be in moderation. So, your equity portfolio that you're going to invest, so out of the 20,000, for example, if you are going to invest, say, 16,000 in equity, out of that 16,000, at least 13 to 14,000 you put in core portfolio, which is large, mid, flexi, multi caps, and so on. And the remaining 2,000 you could put in satellite portfolio funds like your, sectoral, thematic, small caps to slightly better the returns. But since they are more risky, your satellite portfolio funds are very risky, so you don't put them in higher proportion. Clear? So your equity portfolio has to be divided. Now, what are the benefits of adding gold to your equity portfolio? So remember we were talking about that. They tend to move in opposite directions, and a combination of equity and gold can definitely better your return. So if you look at this, right, the lower line is only equities. Had you invested only in equity from 2007 to 2020, and had you invested in a combination of 70% in equity, 30% in gold ETF, so that means 70% of your portfolio went to equity, 30% went to gold, then look at the kind of returns, which is the top purple line, right? Your returns would have been close to, definitely higher compared to your only equity portfolio. So by investing in gold and equity, you've reduced your risk already by investing in a portfolio, and at the same time, you've bettered your returns. What more can you ask for? So if you can reduce your risk, better your returns, that's all we look for. So always a combination of gold and equity is a better thing to do. So always have a small gold proportion to your equity portfolio. Okay. So just to summarize it for all of you, we've spoken about hybrid funds. We have conservative, we have aggressive hybrid funds, we have dynamic asset allocation funds with their timelines. When we're looking at asset allocation, you cannot put all your money in one product. You have to diversify. You have to make sure you're putting a little bit in every product. Now, when you're looking at your asset allocation, you have your strategic, which is your long-term asset allocation, tactical, which is your short-term asset allocation. So for your short-term goals, so when you have your financial goals in place, for your short-term goals, a combination of fixed deposits and debt funds. For your medium-term goals, a combination of conservative hybrid and aggressive hybrid funds. So for 2 to 4 years conservative hybrid, 4 to 7 years aggressive hybrid. And for your long-term portfolio, it is a combination of equity, debt, and gold. Very small percentage in debt, slightly higher in gold, and a big chunk in equity. 70 to 80% in equity. And within equity as well, you split it up between core portfolio and satellite portfolio. So which means a big chunk of your equity portfolio goes into your main funds, your large caps, mid caps, flexi caps. And your small percentage goes into funds like your sectoral funds, thematic funds, small cap funds, which is your satellite portfolio. And you have to have a slight allocation to gold, which we had discussed. Clear? So I hope this was understood. I hope all of you understood what I was trying to explain. I do believe asset allocation as a topic is super important because it is not just about understanding all your different types of mutual funds in isolation. It is eventually about combining everything to optimize your returns. Okay. So now let me quickly take some questions. Okay, so I have Adarsh who says SGB is slightly good. So sovereign gold bonds, Adarsh, of course they're good. So they should buy RBI. Sovereign gold bonds, let me tell you the benefits and disadvantages. So benefit is that when you're investing in a sovereign gold bond, you get 2.5% interest on your investment amount over and above the appreciation of gold that you're anyways going to benefit. The disadvantage is that when you are investing in your SGBs, they have a lock-in of 8 years, which means 8 years you cannot take out your money completely. After 5 to 6 years, you can take out partly. So then, if liquidity is not a concern for you, if you think that you can leave that money in your gold for the next 7-8 years, then SGBs are fine. But if you think liquidity is going to be important, if you think you will need that money in the near future, then sovereign gold bonds may not be a great idea. Then you could look at exchange traded funds or gold mutual funds. So it completely depends on the time horizon or the liquidity that you're expecting from that particular investment. But SGBs are definitely good if liquidity is not a concern for you and if you're okay to keep that money in gold for the next, say, 7-8 years. Okay. Okay, Abhijit says, should we consider commercial real estate self-occupied in asset allocation? So when we are looking at real estate as an investment, if you're getting a rental income out of it, so yes, so that obviously becomes a part of your asset allocation because now your rent that you're earning is going to become a part of your income, right? And then based on that, you're going to invest for your other financial goals. So, of course, so your commercial real estate property is now an additional income that you're getting, and eventually, using that income, where can you invest further to be able to manage your other financial goals is how you will look at it. Okay. So suggest good fund for SWP. So, Chotu Bhai, as I said, SWP is a way of taking out the money from your mutual funds. There's no in every fund that you're investing your money, you can do an SWP. There is no thing that only in one particular fund you can do an SWP. So, from any mutual fund, you can take out the money on a regular basis through the SWP mode. So it's like your SIP. What is SIP? You are investing on a regular basis in a particular mutual fund. In an SWP, you're taking out money from your mutual fund on a regular basis, irrespective of which fund you invested in. So you say you have a list host of 10 funds in your portfolio. Now from those 10 mutual funds, you could do an SWP in any of those funds. There is no problem. Thank you, Narsimhan sir. Thank you for your kind words. Okay. Pratik is saying, can debt funds for long term beat inflation? No, Pratik, your debt funds are only for the short term, they're not for the long term. Debt fund maximum time horizon would be, say, 2 to 3, 4 years, maximum 5 years, not more than that. Because debt fund as a category is there to provide you stability in your returns. Debt funds could definitely reduce your, can definitely better your returns and reduce your risk as compared to, say, fixed deposit. But for the long term, equity is the only one that will help you in terms of beating inflation. Okay. So Abhijit is saying is 60% equity, 40% fixed income, the best allocation. So see how much percentage you do, Abhijit, is truly depending on your financial goals, right? If you have most of your financial goals which are short term, then a big chunk should go into fixed income. But if you have most of your financial goals which are long term, then most of your investments should go in equity. So it completely depends on your financial goals. Okay. Long term financial goals, equity, short term financial goals, fixed income, medium term financial goals, combination of the two, and little bit of gold throughout in your portfolio is the mantra that you should follow. So great. So I think with that, let's end the session. I think the questions are over. I do hope the session was useful, and I'm going to do the same session in Hindi at 12:30. So for those of you who want to listen to me in Hindi, feel free to join me at 12:30. So thank you so much, guys, and I wish you a happy weekend. Take care of yourself, and bye bye.